For today, we'll continue with concession asset, MPSAS 32. Okay. Right, so let me present. All right, you can see my screen, isn't it? Can you or cannot?
Yes, sir.
Yes, sir.
All right. So we'll start from this. It's MPSAS 32. MPSAS 32. Okay, so on service concession arrangements, of course, on the perspective of grantor. Grantor here means the government, government entities. Okay, so if you look at the top there in the standards, service concession here referring to transactions or contracts. Okay, service provision contracts based on PPP, PFI, as well as privatization initiatives. Okay, I think for our class, definitely we discuss on PPP and PFI, right? So basically, assets developed, okay, or been used or constructed under these schemes. So how to go about in terms of financial reporting. So this MPSAS 32 provide the standards, how to account for it. All right, before I proceed, any questions? Okay, so a service concession arrangement is a binding arrangement between a guarantor and operator in which the operator uses the service concession asset to provide a public service on behalf of the grantor for a specified period of time. So you can see that grantor here definitely a government entity, yeah? Because the operator, okay, I think you need to recall when we discuss on PFI, right? Private finance initiative where we discuss on, of course, it's part of procurement's topic, where the private sector is basically, I think one of the model was DBFO, isn't it? Design, bid, finance, and operate. Okay, so no, I think the key element there is not only they construct the facility, okay, they also finance. There is a financing element of providing the services, and then operate. Okay, they become operator. So the government become the user of the service. Okay, but it can be multiple. It can be government, or it can be public to use the asset. So if that is the case, then MPSAS 32 is applicable, okay, to account for the asset. Okay, number B, the operator is compensated for its services over the period of the service concession arrangement. Okay, so over a period of time, I think we discussed on in the case of PFI, concession period can go for 30 years, 20 years. I think this is applicable to even if you talk about concession asset, based on concession, long-term contracts. Okay, basically to make it viable for the private sector to get involved. Otherwise, if they cannot make money or they cannot meet their return on investment, it's quite difficult for them to participate. Right, so what is a concession asset? A service concession asset is an asset used to provide public services in a service concession arrangement that is provided by the operator, which the operator construct, develop, or acquire from a third party. Okay, not necessarily they construct, but they can also through acquisition. And it's an okay, it's an option there. It's an existing asset of the operator, or it's provided by the grantor. Okay, so in this case, the asset is provided by the grantor, which is an existing asset of the guarantor or an upgrade to an existing asset of the grantor. So these are options, the source of the asset. Still, it can be recognized or accounted for under concession assets. Right, now we move on to recognition and measurement. Okay, the grantor shall recognize an asset provided by an operator and an upgrade to an existing asset of the grantor as a service concession asset Okay, so the recognition of the asset as a service concession asset, if they can meet one of these two, I think these two conditions, these two conditions. Okay, the grantor controls or regulate what services the operator must provide. Okay, so the services within the control of the government entity. Okay, it is not at the discretion of the operator. And okay, to whom it must provide them at what price? Even the price is controlled by the government. And the grantor controls through ownership, okay, beneficial entitlement or otherwise. Okay, so not only through ownership, by benefits from the asset generated from the assets. Okay, there's also I think the element of control to recognize the asset. Okay, any significant residual interest in the asset at the end of the term of the arrangement. Okay, so also need to be transferred. Not only they control during the service of the asset, that is provided by through the asset, but at the end of the term of the arrangement, okay, that basically the government still in control or still receive benefits from the assets. I think this is pretty much very consistent with when we discuss PFI assets in the case of Malaysia. Right, and then okay, recognition and measurement of liabilities. Okay, not only there is a recognition of asset, there's also recognition of liabilities. When the grantor recognizes a service concession asset in accordance with paragraph 9 or 10, the grantor shall also recognize a liability. Because in the case of concession asset, concession arrangement, okay, there is a identified asset. And then with that, government have that commitment, have that not only commitment, actually obligation, okay, to compensate the concession company. Okay, so it's like definitely it's a liability over the period, over the concession period. The liability recognized in accordance with paragraph 14 shall be initially measured at the same amount as service concession asset measured in accordance with paragraph 11. Okay, so what would be the amount recognized, okay, in as an asset? That the same amount will be recognized as liability. Okay, with the adjustment, if there is any amount of consideration, if there is, for instance, like cash from the guarantor to the operator, or from the operator to the guarantor, so there is an adjustment either to increase or to decrease the amount of the liability. Right. In exchange for the service concession asset, the grantor may compensate an operator for the service concession asset by combination of making payments to the operator. Okay, so it's a liability, the future liability. So in this case, there is they call it financial liability model, okay, to account for the asset as well as the liability. B, compensating the operator by other means. There is the grant of a right to the operator model, okay, including granting the operator the right to earn revenue from third-party users of the service concession asset. Okay, so basically the concessionaire or the concession company, they charge maybe the users. So with that, definitely consistent with this model, grant of a right to use the asset. Or granting the operator access to another revenue-generating asset for the operator use. Okay, for instance, a private wing of a hospital where the remainder of the hospital is used by a grantor to treat public patients, or a private parking facility adjacent to a public facility. Okay, so then this grant of a right to the operator model can be used. Okay, so we see, I think the example. Okay, these are the details that is provided by the standard regarding the financial liability model. Okay, so I think if you look at 6.53A, because there is an obligation. Okay, the obligation, the guarantor, the operator is a guaranteed payment in terms of can be specified or determinable amounts. That's one. The other is shortfall, if any, between amount received by the operator from users of the public service and a specified or determinable amount, or even the payment is contingent on the operator ensuring the service concession asset meets specified quality or efficiency requirements. I think that is like performance based. That's one. The other, of course, the government or the grantor can basically guarantee certain level of revenue. Okay, the grantor shall allocate the payment to the operator and account for them according to their substance as a reduction of liability recognized, a finance charge, charges for services, in the details, because to account for the liability. That is for financial liability model. Okay, I think it's quite okay how to to see the operation of these accounting procedures. Okay, we'll look at the example later. Okay, the other grant of right to the operator model, where the grantor does not have unconditional obligation to pay cash or another financial asset. So in this case, they use a grant of right to operator. The grantor shall recognize revenue and reduce liability recognized according to the economic substance. So unearned revenue shall be recognized arising from exchange of asset between the grantor and the operator. So there is an item here there, unearned revenue. Revenue and reduction liability shall be recognized according to the economic substance of the service concession arrangement. Okay, and third is dividing the arrangement. And I think if there is two elements where there is also use of asset and liability as well, and they divide the treatment. Okay, I think to make it clear what are the accounting entries for all this accounting treatment. So let us go to the manual. Okay, you can check the manual. Before that, any questions? Everybody happy? Okay, someone still try to enter. Okay, 46 still student. Some students are very busy. Okay, they should be busy study at this point. Just focusing another 1 month to finish off your semester. Okay, this one is at the page, which page is it? 57, okay? The manual. Right, we just focus on the scenario. I think with the scenario, they give example, and then I think it's a bit it's a bit easy to understand. So what are the relevant accounting treatment? Okay, the first of all, financial liability model. So look at this example. An entity, the grantor, enter into a service concession arrangement. Okay, so sorry, a service concession agreement. So you can see that service concession contract is there. So it's very strong, okay, because once you enter into a concession contract. With the local concessionaire, company C, the operator to deliver public service arrangement. Okay, so of course in this case, they don't, it's basically roads. I think it's quite common, I think Malaysia, where you have a concession road. That, okay, in this case, I think they make it simple. That the grantor will pay, okay, the amount. The terms of the arrangement require an operator to construct a road completing construction within 2 years, okay. So construction period within and maintain and operate the road to a specified standard for 8 years. Okay, so after the completion, okay, then the operator will maintain and operate. So maintain is basically maintaining the road. So there is cost for maintenance. Then operate. Once operate, you can generate revenue. To specified standard of 8 years. So from year 3 to year 10, right? The cost of constructing the road amount to 1,050,000 as advised by operator. So that will be the amount agreed. I think any amount, once it enter into a contract, definitely the amount must be honored. The annual depreciation taken by the grantor is on a straight line basis. So you can see that once this amount is considered as an asset, so PPE standards triggers in. The terms of the arrangement require the grantor to pay the operator 200,000 per year from year 3 to year 10 for making the road available to the public. Okay, so you can see that these are basically services. Okay, so but who pay? The government pay. Okay, so quite interesting. In the sense that government is paying, okay, instead of paying the user, charging to the user. The total consideration is a payment of 200,000 from year 3 to year 10 is intended to cover the cost of constructing the road, Okay, so and annual service expense. So the 200,000 cover two. One is the cost of construction, the other is service expense. Okay, so not only for the liability. Yeah? The terms of the arrangement also require operator to resurface the road when the original surface deteriorates. Okay, so resurfacing, I think that's quite common also. If you see maintenance of the road, not only maintenance, cleaning, and pothole. So recently, when the road are not properly maintained, so accident can happen, isn't it? So what happened recently? There was an accident involving a minister. Anyone? Were you aware of that news?
Yes.
Okay, right. So I think that also interesting. Yeah? It's consistent. I think we discussed this. So the potholes. So I think the Minister of Technology, KJ. So basically involved in the. I think he fell, isn't it? He fell, and then so you can see that there is, because he's a minister, of course, all the government agencies swiftly responded to the call. Anyway, but that's how important it is to have a very good quality of road maintenance. And right, so okay, so but on top of that, not only maintenance, but they do resurfacing. Yeah? So it's not a total reconstruction, reconstruct the road, but it's just a resurface. So I think because of wear and tear, and then after 8 years they do resurfacing. But is I think it's amount to capital expenditure that type. So 110,000, that's the estimation. Okay, in year 8. Okay, by year 8 there will be a resurfacing job. The road surface is recognized as a separate component of the initial fair value. Okay, then will be treated accordingly. Yeah? Right. Not only that, because there is, in this case, the concession, because there is a financing element. Okay, they have this interest rate or financing rate. The rate implicit in service concession arrangement is set at 6.81%. Of course, I mean this is basically based on the payments, based on, I think definitely determined by the the concession company. I think most likely how they decide this amount of charge. Of course, through agreement. These are basically based on concession agreement. The road has an economic life of 25 years. Okay, that will be useful for the PPE treatment for depreciation. At the end of the concession period, the ownership of the road is transferred to the grantor. Okay, I think that is the requirement of the standard. At the end of the period, then there must be an ownership transfer to the grantor. The road will have a remaining useful life of 15 years. Okay, so another information, fair value. Okay, the road is because in year 1 and 2 years construction, 940,000, and then for the surface in year 8 and 10, okay, total value 1,050,000. Annual service component is 12,000, and also there is a service charge, the expense, okay, interest expense there. Right, now we move on to the journal entries, okay, during the construction. Right, so year 1, year 2, so debit asset under construction. This is in the grantor book. Okay, for the construction cost, that will be the basis for recognition. Okay, debit asset under construction, credit concession liability. Okay, because the liability, the repayment will start in year 3, right? So it is just a credit on concession liability. And then for year 2, another half, right? Same. Okay, once in year 3, there will be completion. So you can see that the counting record on the accounting entry on completion of the asset. So debit concession asset. So there is a caption there, concession asset. Credit asset under construction. Okay, so zero rise. Then all the amount is transferred to the concession asset. Okay, upon completion of the highway, of the road. Okay, to record depreciation, I think you can read this, because they use basically what do you call it? Straight line, straight line. Okay, but there are two levels of treatment for 940 and as well as from year 8 for the 110. Okay, so need to recognize accordingly. Okay, to record the service expense, right? Okay, from year 3 onward, then they have to pay for the service expense, which is 12,000. So debit service expense, credit concession liability. So concession liability will increase with 12,000. And then to record the finance charge. Okay, the finance charge also is there to account. Okay, how they come up with 32,000 and all that. So we'll see that. How they account for this because the amount basically based on the amount due. Okay, because if you look at the total amount here, it's basically financing. Concession liability here is basically the concession company is financing this construction asset. Okay, so there is a charge, definitely there's a finance charge, okay, or finance cost. Right, and then, okay, now when the operator, the grantor start paying, okay, so credit cash, okay, debit the liability, the concession liability by 200,000. Okay, well, that is for year 3 onward. Okay, now we look at in terms of recognitions, what items are related. Okay, so this table A1 regarding the cash flow, 200,000 each, okay, up to year 10. So the payment, you can see that net inflow or net outflow. These are in the book of grantor, so definitely they have to pay 200,000, right, from year 3 onward up to year 10, because 10 years is the concession period. Then look at table A2 regarding item related to statement of financial performance. Okay, service expense is recognized from year 3 onward, 12,000 annually. Are you with me, class? Yes or no?
Yes, sir.
Okay. Finance charge, right? Okay, so finance charge, you can see that initially 3,000 and then jump to 67 because, more financing, okay, the total of 1 million. And then reducing, because less liability. So it's like a loan, isn't it? In terms of the treatment. But in terms of figure, I will see. Okay, depreciation, okay, I think using straight line. Okay, and then there is surface, depreciation for surfacing. Okay, I think, yeah, original layer, they separate total depreciation. So all these items basically have impact on the financial performance. So these are the total net. All these are basically for the grantor is all basically outflow related to the deficits. Okay. Right, since we are calculating, is only finance charge is shown here. So how to calculate, I provide you with the, this one, I think we have to make up. It's not provided in the manual. Okay, so you look at the finance charge there. I shared this in the Excel file. You can download that as well. So let's say, of course, the charges start from year 3, the finance charge. Okay, and you can check, but I think it just focus on, because we are talking about the payment of 200,000. Okay, look at liability reduction there. From year 3, the payment start paying 200,000. Out of 200,000, 12,000 is basically for service expense. 67,000 is basically for finance charge. So then for liability is basically what is left. Okay, what is left is basically to reduce the liability. Okay, 200,000, but because they have to do the same 200,000 is basically need to pay for service expense and finance charge or finance cost. Then the remaining balance is for the liability, reduction in liability. So only 1-to-1 for year 3. Right, so how to compute the finance charge? These are the table for finance charge. Okay, for instance, like the beginning balance of liability in year 3, 1,082, right? And then the reduction of liability. I think if you look at the finance charge here is basically, okay, yeah, based on the beginning balance. based on the beginning balance times the effective interest rate there. Okay, so you get 67, and then reducing up to 11, finish. Okay, so with that, in year 10, at the end of year 10, the liability becomes 0. Of course, I just make, there's an adjustment here to make it consistent, because of zero rise, there is some error. Right, so these are basically, if you look at the finance charge here, okay, these are the, I think the item that is being shown in the table there. Okay, hold on. Yes, 59, 51, 43 up to 11. So that's basically how to compute. Okay, how to compute that figure is based on this. All right, that's for finance charge. Okay, that statement for financial performance. And then we move to the statement of financial position. Okay, there is asset there. Okay, increasing from 525 to 940. Okay, and so forth. And then at the same time, these are net book value after deducting accumulated depreciation. Okay, and then this one is for the origin, another part of it. Okay, and then we look at the liability. Okay, look at the liability. So if we look at the financial liability, there is a year 1, year 2, they increasing, and then from year 3 it start reducing. So this how the reduction. Okay, so you can check this from this reduction of liability here. So basically this one, right? So with the corresponding figure amount. Can you see this, the Excel file? Yes or no?
Yes.
Yes, sir.
Okay. Right. Exactly. Right. So 343,177. Okay, you can see that clearly. Yeah. All right. So that is basically for financial position. Yeah. Okay, and then this one all relevant items. In terms of reduction. Okay, you can check here. Right. That's for scenario A. Okay, one example, basically for financial liability model. Okay, if the treatment for the concession can meet the financial liability model, that will be example of the corresponding entry. Right, now we move to scenario B, okay, using grant of right to operator model. Okay, look at this. I think it's quite interesting as well. Okay, there is no liable payments, the obligations to pay. Okay, but at the end, but at the same time, the operator still have to develop enough or have to generate enough income by charging the third party. Following on from scenario A, the term of the instrument now only grants the operator the right to allow the operator to collect toll from drivers using the road. Okay, that's quite familiar, isn't it? The operator forecasts that vehicle number will remain constant over duration of the arrangement and will receive toll of 200,000 in each of year 3 to year 10. Okay, the rest are I think the same, right? But under grant of right to operator model, okay, slight different. Instead of concession liability, okay, they call it deferred revenue. Okay, deferred revenue. Of course, deferred revenue is also a kind of, is it an equity item or a liability? Deferred revenue. Class? Okay, debit asset under construction is the same. Okay, but credit deferred revenue under this model in year 1, in year 2. So this deferred revenue is what item is what kind of item is it in the statement of financial position? Is liability. Okay, it's a liability item. It's a liability item. Okay, it's not equity. Okay. So I think from here, although look at this, even though the operator they can collect toll, but for the government perspective, they still recognize that as liability, yeah? As liability. Okay, interesting. I think there was maybe there is a term that is basically if they cannot collect the liability, they can also, you know, maybe government have to compensate. Okay, but nevertheless, just take note of that. Okay, for other, I think this is the same with scenario A. Right, upon the completion, this one is from year 3 to year 10. Okay, look at this. The grantor will recognize revenue on the basis of access to civic concession. Okay, there was right. So you can see this, how they basically reduce the deferred revenue. Okay, so it's just divided by the concession period of 8 years. Okay, so the total asset, okay, what the amount of recognition of the asset, that also the reverse the entry, isn't it? Okay, so if you look at the entry here, debit deferred revenue and credit revenue on concession asset. Okay, so that's the accounting treatment. So in this case, the grantor basically they recognize revenue on concession asset. Okay. Right. That is for for the reduction of liability. Right. In terms of cash flow, the same. Okay. Now we move on to statement of financial performance or item related. Okay. There is a recognition of revenue. Okay, with the reduction of liability with 145,000 because they use their straight line basis. Depreciation. Okay, that is similar. Right. So under this model, from the statement of financial performance, the grantor can recognize surplus. Okay. Right. So in this case, 89,000 for year 3 and so forth. Okay. Now we move on to statement of financial position in terms of, I think, service concession asset should be the same. Okay. Right. Okay. On terms of cash, there is no cash outflow. So basically, the government do not pay. Okay. But in terms of liability, okay, in terms of liability, there's a recognition of liability with the concession asset. But when but once the asset is start to operate, they start to recognize the revenue. So here, of course, liability, but they don't call it concession liability. They call it deferred revenue. So with that, there is a revenue being recognized, a reduction of liability. Okay, balance front forward. Right. I think, of course, this model is a bit straightforward. Okay, in terms of the calculations of the revenue and also the reduction of liability. Okay, one thing, of course, you don't in this type, right? So service cost, finance cost is not charged. Finance cost is not charged to the government. Okay. And yeah, right. So the only, look at this financial position. Yeah, the only expenses accrued by the government is basically depreciation. Depreciation. So even the maintenance costs not accrued to the government. Okay, these are some differences. Okay, of course, all these need to be demonstrated in the terms of the contracts. In the terms of the contracts. So assumption here definitely these are clearly spelled out in the contracts that allows this kind of accounting treatment need to be provided. Okay. I think pretty much that's about it on this example. Any questions? If no question means what? Okay, so I think that's about it for this topic. right? Okay, do study them. When is your final exam for PSA?
19 January.
19 November.
19 January, yeah?
19 January.
19 January, so basically 20 days from now. Huh? So how's your assignment? Okay. Then I stop presenting. Eh? Very quiet. Okay. Then smooth sailing. Eh? Working on it. Okay. If no questions, all the best. I think you still have half good 1 hour. All right. Next class I will cover on. So basically. So today and hopefully by so next class Thursday I will cover audit till next week. So I think next week also we still have one more class to finish off the audit. Okay, and then hopefully by this week or early next week I'll distribute your midterm as well. And I'm finishing marking. Right, since no questions, I think I will stop here with wabillahi taufiq wal hidayah. Assalamualaikum warahmatullahi taala wabarakatuh.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Thank you, sir.